The Honest Money podcast is powered by 10x Investments, a licensed financial services provider. Consult with your financial advisor and let's 10x your future together.
Welcome to another episode of Honest Money. I'm Warren Ingram.
I'm Pieter de Villiers from Money Marks.
Thank you so much for watching and listening. We appreciate it. Please don't forget to subscribe if you like the show. This is the second in a series that we've done. First for me, where we are talking around estate planning just as a broad concept. So in the first episode, we covered the concept of a will, what should go into a will, what shouldn't be in a will, and then making sure that you update it. And so today you've come up with a really snappy title for this topic.
Yeah. How to die in the most cost and tax efficient way possible.
Is it not just die with no assets?
I guess sometimes, yeah, that could be a benefit, but hopefully you have some assets.
So I think just understanding, you know, when we talk about this, it's kind of an expensive business to die.
Yes.
There are lots of taxes. There are fees that have to get paid to professionals. There could be multiple layers of taxes. So you might think, okay, well, it's just going to be estate duty or probate if it's an overseas thing. But there could be capital gains. There could be transfer duties if there are properties involved. So unfortunately, over and above the trauma that your loved ones will feel when you die, there might be a real financial cost implication to dying. So I like the title. It's snappy, but it is real. That if you can do a little bit of forward planning when you put your investments together and you put the structure of how you own things together, you can potentially save your family a lot of money. While you can't save them the heartache, you can potentially give them as much money as possible in the most effective way.
Yes. And this ties back into the will discussion. It's you're doing it not for you, you're doing it for your family. You're not going to be here, so you're not going to know, but you know now that you want to structure your wealth in a sense that if you're not here anymore, try and make that process as seamless as possible for your family to get what you've built up for them to fulfill those legacy needs, which we've touched last time. It could take a long time to actually finalize how to set up a will. So let's talk. I think there's two components to today. There's the costs involved, so we cover kind of like the main big ones, and then there's tips on how to do proper estate planning. What are the kind of the big wins that you can look at? And generally, in this sense, this space, we like to talk a lot about DIY kind of approaches, but this is definitely not a DIY approach. When it comes to estate planning, you need professionals to help you. This is good for you to become educated and to become aware of what needs to be done. But it is quite a complex type of approach, component of financial planning that needs to be done correctly in the best way possible. So let's start off with the fees. So there's a big one. There's estate duty, which is the taxes that you pay. Now, believe it or not, you pay taxes when you earn money, when you spend money, when you save money, when you invest money, and when you die. So you just get taxed all over. I don't know if you get taxed after you die. Maybe there's some sort of hidden tax there. One day we'll find out. But when you die, what happens is all the assets that you own, everything that has your name on it, gets lumped together, and then there's a estate duty applied on that. Now, the first 3.5 million is estate duty free. It's called an abatement, and then after that, you are taxed at a flat rate of 20% up until the 30 million mark. And then after that, it's 25% above that. So this can, if you have a lot of assets, this can become quite a hefty fee that you need to pay. But if it's below 3.5 million, that's usually not a problem. Now, that doesn't mean all the assets that you own. Some assets will fall outside of your estate. So things like retirement annuity, a pension fund, a provident fund, those Regulation 28 funds falls outside of your estate. And generally, those won't be estate duty applicable. And then if you use other types of structures like a trust, for example, that removes assets out of your name in a different entity, and that will not be estate duty applicable. Trust is maybe the next episode that we'll do. So we'll go a bit deeper into what a trust is and how it works. But those are generally the estate duty around the taxes that you'll pay. Now, there's also the guy that administers the estate, that makes sure all the insurances pay out, all the debt is paid off, everyone, all the professionals receive their fees, the taxes, again, that's called an executor, and they've got a fee on all the assets that they manage. So everything that they have to touch. They have a fee of 3.5% exclusive of that. That can be negotiated down if you have a large estate. And now there's some assets again that falls outside of the executor's hand. So let's say you've got a life cover policy on your name and you nominate your spouse, your wife or your husband, and that life policy will pay out directly to them. So the executor doesn't have to touch that. So that's then executor fee less, meaning that there won't be executor fees attached. Now that could be a substantial saving. If you've got a life cover policy of 10 million rand, for example, and there's a 4% fee on that, that's going to be a lot. So this is important to understand if you have life cover, how it pays out, who are the beneficiaries. And if you have no beneficiaries, what's going to happen, it's going to pay out directly into your estate. It's going to be a state duty on that policy and executor's fees. That may not always be a problem because if you die, there's a lot of costs involved and you want to have enough cash in your estate. So either cash in the bank or a money market or life cover that pays into estate to make sure we pay all of these fees. That's called the estate liquidity. If you don't have that, then either assets needs to be sold off in the estate, like a house that was meant for your family to stay in, or they're going to ask your spouse or family to now go and pay these fees because this needs to happen. So those are the two big fees. There's also a master's fees, which is the guy in the court that has to actually say, okay, your estate is finalized, stamp of approval. They earn a fee. It's about maximum 7,000 rand. So it's relative to the rest, not too big. If you have to transfer property to someone else's name, there's property transfer costs involved around how that happens. And then if you have assets, if you die, it's called like you're disposing of all your assets. It's like everything gets sold off. So all the investments you have, everything gets liquidated in the sense that you've bought it at a certain point and then you sell it at that point, the value, and that difference, that capital gain, also is applicable to capital gains taxes. Now, again, there's certain rulings around what you put in your will that can help to mitigate those types of costs that we'll get to in a second. But I would say those are the big fees that you need to be aware of, those big five, I'd say.
Yeah, I think that's a very good point. And I mean, I was racking my brains to see what other one I could add in. Maybe the only last one would be estate agents' fees for the property that gets sold. And maybe just to top up the 1 point there, so it's 3.5 million. The first 3.5 million of my estate would be without estate duty. If I'm married and I leave my whole estate to my wife, and just for my wife, I know you'll listen, it is all going to you, I promise you. And then she dies, then that'll add up to 7 million.
Yes,
so that's called a rollover. So that's important to know that actually when you're married, there are lots of benefits to being married, but this is one of them, that you get this rollover and that you're saving or deferring, let's say, rather, your estate duty to later. So then it could be 7 million per couple, per married couple. And then also on executors' fees, am I right in saying if you've got a retirement fund, the executor doesn't charge fees on that as well? So, I mean, is our next point around saving, how to save money?
Yes.
So can we get into that? Because I think it's one of those things where people with, you have a fair amount of assets, they often forget about the benefit of retirement funds. So, there's always the skepticism. You and I get these questions all the time. People saying, I don't want to add money to my RA, I'll rather put it in my tax-free savings. Okay, it's not a bad call. But once you've maxed out your tax-free savings, making good contributions to retirement funds during your lifetime, or when you're older, not kind of eating down your whole retirement fund before you die, the reason why it could be a very good call is actually that money moves from your generation to your kids, and no executors' fees, no estate duty. So it can be an enormous saving. So actually, if a 40-year-old adult, inherits, 25 million rand living annuity, that's basically their retirement funding done. Yes, they have to earn a bit of income from that living annuity, but you've done that already, and there's no taxes involved in doing that. And actually quite a quick, seamless process as well. I think that's the other thing. Those retirement funds, for this purpose, is almost like a life policy. It pays out fairly quickly. Yeah. So I think that is a very big saving. I think nominating spouses is a good way of deferring costs as well. And then also when you get older and you're starting to accumulate assets, I made a bit of a joke at the start to say that, one of the ways to save a lot of estate duty or costs is just to have nothing. Now, no one can get their planning done that well, but one of the things you can do is actually you can use your annual donations benefit. So you can donate to anybody 100,000 Rand a year without paying tax. Now, if you are older and you've got adult children and you know you're going to not use up all your money in your lifetime, seriously consider donating 100,000 a year to your kids, or if you don't have kids, to a charity, because the charities doesn't matter. I guess they're not going to pay tax, but reducing your estate, the size of your estate, by actually giving money to your beneficiaries earlier while you're alive has a huge benefit to them. They can certainly use the money, I can promise you that. But secondly, it's making your estate duty, which means less executors' fees, less estate duties.
Yeah.
Those are the good ones I can think of off the top of my head.
Yes, and just nominating, but going back to the will, if you say, listen, I'm happy if everything that I own goes to my spouse, that's a massive tax saving from estate duty, because what happens is after we've added all the assets that you own, there's an amount, then we get deductions that we can deduct from that. And then there's the residue, kind of what's left over. And that's then after deducting the 3.5 million, that gets applied to that 20%. But if you say everything goes to my spouse, it rolls over to them. So then estate duty won't be applicable now. Capital gains tax will also roll over for the assets that you own. So that could really drastically cut down the costs when you pass away. Now, when your spouse passes away, they're still going to pay all of those things, but it's a deferred kind of like taxes. That is generally always a good idea. We talked about life policy, so just make sure if you have a life policy, it pays out correctly. So if it pays out to a spouse, also there's no estate duty or executors fees. If it pays out to a third party, it's like a child, then depending on how it's structured, there could be estate duty still on that. If it pays into the estate, it will have estate duty. So it's just always a fine balance of understanding how that should pay out. But again, a professional needs to help you with that. And then you mentioned donating to charity. So that's also a estate duty deductible, where you say, okay, I want to, in my will, this amount needs to go to this animal shelter. That's a deduction on your estate. So that means you pay less taxes. So that's a nice type of kind of something to leave behind, and to pay less taxes essentially in that space. And then in terms of executors fees, that can also add up, that 4% inclusive of that. So the way to mitigate that is nominating beneficiaries on your life policies, because then the executor doesn't have to deal with that. And secondly, endowments, something that we also don't speak about too often. But an endowment means it's an investment within a structure, insurance structure, that says that if I pass away, I nominate my wife, for example, as the life assured. So the investment continues to live on and she becomes the owner. But then you'll still pay a state duty on that, but executors fees won't be applicable. So you save on that 4%. And if you have this also includes offshore endowments, so offshore assets. So if you have a substantial amount of many millions overseas, putting that in an offshore endowment could be a good idea, because you save on that 4% executors fees that could potentially be applicable on that. So I think from a estate planning point of view, try and lower costs, retirement funds, endowments, those donations, I think that's a great idea. And between us and a married couple, like a spouse, you have 200,000 Rand per year, because you can donate to each other as much as you want without paying taxes. And you both have 100,000 that you can pay out. So you can actually, between the wealth, combined wealth, you can donate to 100,000 Rand per year. If you can donate more than that, there's 20% donations tax on that. So just be careful of not exceeding that. And yeah, that's kind of like I think the major cost savings on estate planning that I can think of top of my head.
Yeah, and just on that point around the donations, I mean, if that's a big concern for you, that you want to reduce the size of your estate and you're elderly, I mean, doing the donations, yes, you'll pay the donations tax, but you at least would save on executors fees. So even there, I mean, it's your point that you've made well is spend some time with an estate planner. If you've got a large estate and you want to try and make it as tax efficient as possible and do the right thing for everybody involved, spending a bit of money on estate planning will save a fortune in taxes and costs, but also in heartache into the future. I mean, maybe we're gonna talk about trusts in another episode, but I think just to highlight again here that if you're younger, so I think setting up a trust when you're 89 and in bad health, I'm not sure that's going to save a heck of a lot of taxes or costs into your future. But if you're younger and accumulating money, or you have a lot of assets, then making use of a trust is something to consider. We don't want to give away our future topics now, but just to float it, that trusts are often a vehicle for helping with this, but they shouldn't be set up just to save taxes. It's not an efficient way just to do that. There need to be other purposes.
Yeah. And one thing I'll also highlight here is the way that you are married. If you are married, the marriage contract also affects the way that your estate plan will look like. So if you're married in community of property, your picture will look different than someone that's married outside of community. And if you have accrual, so married outside of community with the accrual, there's also a calculation that needs to be done there. Because if you die and you have a lot less assets than your spouse and you're married with the accrual, there's a calculation that your estate can then have a claim from their estate, and also vice versa. So again, it's there's a lot of moving parts over here. It's good to have a professional to help you with that and to map out everything and to revise it as well, because the estate plan also changes with time.
Yeah.
As you accumulate more quantity of assets and value of assets, your estate planning becomes also even more important.
And what I wanted to say is you can see all of this stuff was developed by lawyers, because man, it's complicated and complex, and the language is difficult. So unfortunately, we're sorry we don't like jargon on the show, but when we get to this stuff, the jargon is there, and so again, make sure you get advice and do the plan.
Yeah, and one thing I want to add to this is if you have offshore assets, this is something we've touched on a couple of times in previous episodes, but if you have money and invested in assets outside of South Africa, it's very important to understand where that asset sits, where it's housed, the site is. So if it's in America, US domiciled, let's say ETFs or unit trust, then not only are you going to most likely pay CITES taxes, so their version of estate duty, if it's above $60,000, they've got 18 to 40% range over there. If it's in the UK, above £325,000, you pay a flat 40% estate duty. Now you can imagine if you have a lot of assets in South Africa, at the most you'll pay 25% in estate duty if you're like one of those above 30 million individuals. But if you have assets overseas in one of those jurisdictions, you will pay on top of this 25 up until that 40%. Now, if you pay taxes that side, you get tax credits this side, but still your total estate duty liability can go as high as 40%. Now, just imagine if you've built up so much, you've worked so hard to build up so many assets in your lifetime, and then at death, almost half of it gets wiped by taxes in a country that you don't even have never visited maybe. That sucks. So if you take money overseas, make sure it's in a tax-friendly jurisdiction. So Switzerland, Ireland, Isle of Man, the Channel Islands, they are generally well structured so that they can communicate with South Africa and there's no estate duty. That's one component. But the other one that I think many people don't know about is if you have money overseas and in a jurisdiction where it's not so friendly for South Africans, then it's also going to take a lot longer for your estate to be wound up, because in order for your family to receive the benefits in your estate in South Africa, everything in the estate needs to be settled. Your debt has to be paid, your taxes has to be paid. This includes offshore assets. So if you have assets, let's say in America, and you die, then your executor will have to probably appoint someone on that side, a lawyer, to figure out how much taxes you need to pay there. And then the IRS needs to give the stamp of approval that your liability that side has been paid in dollars and you have rands. And then only once that is settled can your executor in South Africa settle your estate and your family can receive your funds. So that's something that I've recently learned is that can take a lot of extra time and that could add potential months or years to your estate being wound up. So you don't want to, again, put your family in destitute, because you may have a lot of money that you could leave them, but it's frozen because there's offshore business that needs to be concluded. And always, if there's more parties involved with any type of transaction or any movement, it's just going to take a longer time. So make sure that if you do go overseas, and also if you have other types of assets, property and businesses in different jurisdictions, you have to, we talked about this earlier, maybe have a foreign will so that those wishes are recorded that side as well. I don't know if you've got any.
Yeah. I mean, I just think you know, for me, there's a bank, South Africa, that will quickly and seamlessly open you up a bank account in the UK. And that's fine when you've got £5,000 there, but if you've got, as you say, over £325,000 there, all of a sudden you're stuck with estate duty there. And lots of us are very aware of a lot of American shares, American ETFs, and we might want to buy those. And then you open up American stockbroking account because it's low cost, and then you buy American shares. And if you invest for a decade or two, it's very easy to get over that $60,000 level, and then you're potentially leaving behind a real mess, both in taxes and time. So I would encourage people that if you're going to invest overseas, we think it's a very good idea. It's good diversification. For example, Berkshire Hathaway, you can buy a Berkshire Hathaway that's denominated in euros. You can buy so it's an alternative listing. That's not a bad idea. You can buy, if you want to buy a world index, you don't have to buy the Vanguard World Index sitting in the States. You can buy a world index that's listed in the Channel Islands or in Ireland, and or in Switzerland. So make sure that you do that. The other thing that bothers me is a lot of the time people say, look, here's a platform, it's in Switzerland, we're going to buy you a bunch of American shares, the IRS won't know. Oh, I mean, I can't use the words I wanted to use there. That would be rude. But that's not true. And the tax authorities are integrating with each other all the time. So don't rely on the fact that you've got an account in Switzerland and then you've used the Swiss account to buy shares in America and think that if you die, you're going to avoid estate duty and the like. That's not necessarily true. And if there is one tax authority in the world that you don't want to mess with, it's the IRS. Their tax regime is very tricky. It's very hard to understand. And they've got much more money to enforce and chase down people that they believe owe them money. So you just want to avoid that if you possibly can.